Morning, everyone. I'm Richard Begley from the Economic Regulation Authority of Western Australia. So this morning we're here really just to give you a flavour of what we do at the practical end of regulating natural monopolies. The sort of plan is that I'll give you a bit of a quick helicopter over Regulation 101 as we sort of see it at the ERA and the way we do things. And then my colleague Stefan will pick out some of the more interesting topics and hopefully engage a bit more in depth. A couple of things to say. We at the ERA have a statutory function under legislation for regulating gas pipelines in Western Australia and also electricity networks, the Western Power Networks. And also rail regulation as well. So that's sort of quite a formal process that we undertake. Other than that, though, we from time to time get references from the Treasurer, and we're currently got one of those in relation to pricing for water in the state. The other thing I need to say right at the outset is that we're from Secretariat and we're not the ERA. The ERA is the authority and we have a board who is the authority, and so anything I say today is couched in terms of our personal opinions. It's not actually, I'm not speaking for the board, so given that this is being recorded I need to make that very clear up front. And with that, Stefan, we can let loose.
Okay. Works for a gas or electricity, chance.
So why regulation of monopolies? Well, for the economists in the room, this is sort of like pretty basics economics 101. Unlike the sort of competitive market situation, we're talking about monopoly where there are economies of, or typically in the sort of networks that we deal with, economies of scale and network economies, externalities and the like, which mean that you end up with a single firm generally, often with downward sloping average total cost and marginal cost curves, and also because it's a single firm it can influence price, so it has a downward sloping demand curve. And for the classic condition of setting marginal revenue equal to marginal cost, the monopolist will tend to do that and end up with a much higher price than is socially optimal, with a deadweight loss of consumer surplus as a result. So we as regulators are charged with actually delivering something in here which is much more social optimal in terms of maximising economic welfare. Typically we try and end up somewhere out here with marginal cost around the average revenue, and if we do that, though, you'll find then that average revenue is below average total cost. So that means for the monopolist that they are losing money on every unit sold, pretty much. So then economists have come up with ways of dealing with that where you might set a variable charge equivalent to the marginal cost and recover the residual to average total cost through a fixed charge. That's so-called two-part pricing. So that's just the very basics of what we're doing. And we have, as I mentioned, we have statutory functions, and enshrined in that is an objective for us to promote efficient investment in efficient operation and use of whatever the monopoly service might be. And there's this classic term that we use all the time, in the long-term interests of consumers. And that means not just today's consumers, but also tomorrow's consumers, because monopoly assets are very long-lived items. They often go for 80 to 100 years. So, we need to be thinking out that far, although there's an interesting question in that, which I think Stefan will probably touch on a bit later. Important to recognise there's a balance in this. We see that the long-term interests of consumers, these are often essential services, so consumers don't want to see the lights go out or the water stop running, so they are very interested in seeing viable businesses to be able to continue sustainably into the future. So really wrapped up in that long-term interest of consumers is also the long-term interests of the business itself. Okay, so how do we go about it? Well, generally at the ERA, there are a number of different ways of regulating. You can have sort of rate of return regulation, which was one of the first, where you basically look at the firm itself and you know, give it something that you think's reasonable, building up its cost of service. Then it sort of developed into more yardstick type regulation, where you set benchmarks and you try and suggest that the firm should earn revenue equivalent to the benchmark. And then, you know, there's incentive regulation with price or revenue caps. And really what we do at the ERA is a combination of all those things. So our primary approach is to have what's called the building block approach, where we're building up a number of different blocks relating to OPEX, relating to capital costs, which include the return on and of capital, which I'll talk about in more detail, a bit of revenue to cover their tax requirements. And so basically we look to do that. Also, an important thing we also look to do is to try and achieve appropriate incentives for the businesses to keep innovating and to achieve efficiencies over time. So this sort of idea of incentive regulation. And the way we often do that, well, the way we like to think about it is that we tend to set a revenue path going forward for, say, 5 years typically. And the idea is that we think we get that right every time. And then but the businesses are then incentive, you know, they can beat that and keep the revenue that they get by beating that. So provided we've got it right, if they beat that, then they've adopted some efficiency or productivity gain that we weren't particularly aware of, or they discovered. And then, of course, when we come in 5 years' time to regulate again, we can look back and we can see what actually happened, and we can go, oh, look, you know, things have moved on. It's now cheaper. And so we'll set the benchmark a bit lower, and that way consumers get to share in that innovation as well. So that's the idea behind incentive regulation. Okay, so I've talked about these things. OPEX is a very important component. Generally, it's about up to 45% of the total revenue that we provide is there to cover off operating and maintenance, and we look at the efficiency of that in some detail. But I think what we'll probably talk today more about is the return on and of capital, being sort of more interesting and a bit more technical. And that's worth about 50% of the revenue. So it's a really important area for us, and it's an area where, you know, we're in the trenches with the service providers themselves, and it's backwards and forwards about, you know, what we should be allocating as a fair and reasonable return. So to start that off, we'll talk about the return on capital as opposed to the return of capital, which is depreciation. Return on capital. Generally speaking, we look to develop a weighted average cost of capital, so-called WACC. And because these businesses are essential services with many, many customers and steady cash flows, if you like, you know, there's essential things, water, electricity, we all consume them. They're able to really gear up and to take on a lot of debt, 60% debt often, which is generally almost double what you'd normally see in the corporate sector, which is usually about 30%. So 60% debt and 40% equity. What else is there to say? We're looking for efficient financing costs, which we observe in the domestic market. That takes into account the fact that there are foreign investors in domestic equities, and it also takes into account the fact that domestic firms can raise capital overseas on European and US markets as well. So we sort of count that as being domestic. Another important thing is, I mentioned benchmarking or yardstick regulation. We really do look for benchmarks. We're not taking the specific, you know, considerations of the water corporation itself and the fact that it's owned by the West Australian government. We actually say, no, we just want to know what would the benchmark efficient firm, if it ran the Water Corporation of Western Australia, be doing. And so we look to that. We don't care about the fact that the West Australian government can theoretically get lower cost of capital. That's not our concern. Stefan will talk a bit more about risk, so I might skip over that. The other thing I wanted to mention is that the term of the estimate is important. I mentioned that we look forward 5 years generally for this incentive regulation, and there's an important principle here called financial capital maintenance, or the net present value equals zero principle. We regulators like to think. And essentially that's saying, look, if you've got an investment in $100 of capital and it's going to last for 50 years, we want to make sure that the costs of maintaining that capital over the 50 years is equal to the revenue that we provide for that in net present value terms. And if we can get that right, that means that they're neither over-recovering, making extraordinary profits, nor under-recovering. They're making a normal sort of profit on that, and that's consistent with economic efficiency. Okay, return on capital. There's the return on equity and there's the return on debt. In terms of the return on equity, we use the Sharp-Lintner capital asset pricing model. This is an area of huge contention. There's been literally, thousands and thousands of papers written on models for the return on equity. The Sharp-Lintner capital asset pricing model is one of the earliest, I think, the grandfather of them all really, from the early 60s. We like to think that it's still pretty good. It's elegant, it's simple. It's very difficult to game it, so regulators have tended to stick with that, and so far we've managed to hold that line in the courts because we do get appealed and we do have to go through and make our case to judges and so on. It's pretty simple. It's a build-up of a risk-free rate, which is commonly proxied by Commonwealth government securities, government bonds of some particular term. Usually that, I mentioned earlier that the term's important. And then there's the equity risk premium, which is a combination of the specific risk related to the benchmark entity, the beta, and we times that by the market risk premium, which is the sort of the premium for the market as a whole over time, over and above the risk-free rate. So the market risk premium is very difficult to estimate. It's particularly important because one of the things you have to realise is we're looking forward 5 years. We're trying to say what is the efficient return that investors expect right now for the next 5 years to make them keep investing in capital. And if we don't give that, they may not invest. They may say, oh no, we're not going to add that extra pipeline. We're going to go and invest somewhere else, in China or whatever. So this is quite a difficult thing. And you can look back at the past, at historic averages, for example, but our research, or Stefan's research in particular, shows that data's not stationary, so it's not mean reverting. So you need to sort of take it all with a grain of salt and say, that's one indicator, but, might not be the whole story. So we use other tools such as the dividend growth model. I mentioned there were many, many other models. The dividend growth model is based on consensus expectations of the market, or the one we use relating to earnings and dividends growth, and we combine that with knowledge about prices to give us an expectation for what the market currently thinks the market risk premium is looking like. And it's fair to say that it's pretty high at the moment, or compared to historically, I think a bit high. Ever since the global financial crisis, I think the market risk premiums jumped up, reflecting greater risk these days. Return on debt, similar. We build up from the risk-free rate. And again, Commonwealth government securities, I mentioned that term issue, that we're looking for a 5-year term. Oh, I don't think I actually mentioned that we tend to take a term, we look at a 5-year government security because that's consistent with the regulatory period that we're looking out, and that's important for meeting the present value condition that I mentioned. We also then look at the debt risk premium, which is the return on a sample, a benchmark sample of corporate bonds with the same risk profile we think as the entity that we're regulating. Commonly that's in the BBB band, we find, and so you know, we can go out and that's actually much easier than, say, the for the return on equity for the market risk premium. That's actually something we can observe. A big debate in regulatory sphere in recent years has been whether to use a sort of on-the-day rate, which is, you know, the current spot rate. The idea being behind that, you know, if we set an on-the-day rate now for the next 5 years, tomorrow the regulated firm will go out and hedge to that. So it can actually fix that rate in place. But there's been a recognition that that can be difficult, particularly while it's possible to hedge the risk-free rate quite easily. The debt risk premium is certainly much more difficult, and particularly since the global financial crisis, it's difficult. So there's been this introduction of a trailing average return on debt, where it's recognised that, you know, these big firms, they've got massive investments. You know, Water Corporation currently has got a book of $18 billion worth of network pipes around the place, and so that'll have a tranche, a portfolio of debt which is, you know, tranches that it's rolling over through time. You know, it might drop off 10% and get 10% more new debt up here. So this idea of a 10-year trailing average for the return on debt has taken hold. And I just got a little illustration of this, the cost of debt since the global financial crisis over here. You can see that at that particular time the risk-free rates plummeted. This is the total yield on a non-corporate BBB bond, non-financial, that's non-bank bond, more corporate bond. And you can see that just went through the roof in that sort of October 2008 period. And this difference in here is the debt risk premium. So we've got the sort of risk-free rate, the debt risk premium added on, and then we get the total yield. And you can see then since then it's been trending down. I've drawn a couple of trailing averages in here on the total. The green line is a 5-year trailing average, and because of the data only goes back to about here, it starts there. And then with the 10-year, I'm afraid it only starts over there. But you can see that the longer the period of the trailing average, obviously, the smoother the cost of debt becomes. And firms, currently a lot of regulators now apply a 10-year trailing average to the whole thing. Firms really like that because they can match it exactly, takes out that sort of risk of their non-core business. So that's basically where that's got to.
How recent is that?
Probably since the 2013 gas rate of return guidelines, do you reckon? Yeah. The AR's adopted. Yeah, full trailing average. The last thing I'm going to talk about is depreciation, return of capital. And there's really not a lot to say about this except that there's one little wrinkle in it that's worth understanding that, you know, we deal with. Generally, you can make any schedule of depreciation work in net present value equals zero terms, that financial capital maintenance. Accountants use this one on the right-hand side, the blue one, nominal prime or historic cost accounting, where they just take the, you know, if you bought something for $100, in nominal terms, you just depreciate it in straight line terms. You know, you end up with this sort of straight line over here in nominal dollars. Over here, though, this is the one that we regulators use. We actually depreciate that in real terms. Economists love real values, much more reflective of things. Well, that's just a bit of an aside. If you convert the real straight line depreciation, if you index it up with the appropriate CPI index, you then get this. This is the nominal equivalent of the real depreciation. And because it's indexed, we call this current cost accounting as opposed to the accountant's historic cost accounting. And so what I've done then is I've superimposed this real depreciation schedule in nominal terms over here on the nominal chart. So now think of this as nominal, and you can see here's straight line historic cost depreciation, and here's actually the real depreciation in nominal terms, or the indexed value of the real depreciation. And so you can see that early in the asset's life, given time, this value here is the amount of depreciation you get under nominal historic cost accounting, the accountant's version. Whereas this is the nominal value under the economists' real depreciation. And the sort of cut to the chase, the story is that this one, the accountant's one, tends to reward the asset much earlier in its life. So I've actually, the next slide's a bit busier because this just sets up a little account and it compares in nominal dollars the real versus nominal. So here's the sort of asset closing value, which was those lines on the previous page. Here's the depreciation, here's the return, and here's the total build-up, building blocks added together for the cost of service or the revenue that we're going to give the regulated entity. And really the main story is in this bottom line revenue line, because it influences, that schedule influences both depreciation and the rate of return. They sort of interact a bit. So you've got to look at the total down here. And what you can see when I said that the nominal historic cost accounting, the accountant's approach, basically revenue is 20 here at the beginning and it falls to 11. So it's quite a steep drop off. Whereas real it's still got a drop off, but it's only 17 to 14. So it's a little bit less. And so we regulators prefer the real approach because really we've got these very long-lived assets. As I said, 50 to 100 years. And we have the long-term interests of consumers, so we're thinking about all consumers. And so our view is that basically under this nominal approach, if we were to adopt that, these consumers here would be worse off compared to those consumers. And it's the same in real terms as well. Whereas this is a much more even schedule through time of the rate of return.
So what do you do about water pipe assets that last for 100 years and possibly last for 150 years? They're clearly still usable.
Yeah.
And then, basically they've got a small value that carries on for a very long time.
Yeah, yeah. I mean, it is a really interesting thing as to, whether we would then have a problem with that. I mean, they can continue carrying on. It's just whether they would be written off in the regulatory account. So, possibly they would be fully written off because they were, if we had expected them to last only, say, 100 years and they were effectively not bursting for another 20 or 30 years, well, that's fine. They can leave them in the ground. They just wouldn't get a return on it. But it's quite interesting because that sets up an incentive for the service provider to actually replace that pipe. So there may be an issue about whether we need to revise the life of that asset.
There was a systematic problem as well.
Yeah.
I mean, maybe that offsets with other assets as well, but it needed to be visited as it was a systematic problem. Remember, this is just a benchmark as well. They're allowed to. We're not necessarily trying to say this is the actual absolute minimum cost. You meet that, or else it's a benchmark. It's not meant to be the minimum, so they can get away with a little bit.
And I suppose this is being affected over time as the asset gets older by increasing repair and maintenance costs, I would imagine. It's factored in or it's added to it?
Yeah, no, that is factored in. So, yeah. But, I mean, I think that's part of that build-up of OPEX. We look at what's efficient and we would recognise, I think, that their maintenance costs out here for some assets would be increasing. Yeah, so you could recognise that. And obviously we'd also look at their whole governance process about the judgment of what point in time it's reasonable to replace that asset. Yeah, so we do look at governance processes about their decision making around CapEx and new CapEx. Yeah.
So do you have classes of capital items like buildings, equipment and machinery, and basically by choosing the depreciation rate, you can set the lifetime, right?
Yes.
So is that what you use?
Absolutely.
They tend to be grouped by asset life. So
Yeah.
asset life,
Yeah.
I mean, there's so many different ways of doing it, but the way it ends up is it just tends to be grouped by asset life.
Yeah. So we try and have a sensible number of not too many assets. Pipes, valves, buildings, cars, whatever, computers. Yeah. So there's a range of different asset classes that we would look at, but yeah, not too many. Yeah. So I'm done. That's it. That's the helicopter view of what we do, and I'll hand over to Stefan on that note.
As it was introduced, I'm Stefan, Mero.
Oh, that's a good
yes,
point. Yes,
sure.
thank you.
So I work as an analyst at the Economic Regulation Authority in Richard's area. When we were first told about this presentation, I thought, well, I work on WACC a hell of a lot, and I was trying to think, well, how do I make a topic like the WACC interesting? Not only that, Maxim mentioned that or that you guys would be interested in topics relating to water-sensitive urban infrastructure and renewable energy. We deal with monopoly infrastructure, typically large assets. For instance, we don't deal with generators as such. There's a markets team which does look at the electricity market, but yeah, so I had to try and stretch the WACC into that area to make it interesting for you guys. So I'm going probably a little bit out of my expertise on what I'm about to introduce next, but it's just take some of the ideas that Rich has introduced. In particular, the what is set up for you is the total revenue requirement. So the money that the regulator needs to get back, or that the regulated entity needs to get back off consumers in order to remain sustainable. How that's done is a separate process. So I'll go through that with you. Okay, a risk and return 101. Okay, so a lot of you are well abreast of this, but for those who are not particularly into finance, I'll just give a rundown. So risk is often characterised in modern portfolio theory as diversifiable and non-diversifiable. So examples of diversifiable risk are industry-specific or firm-specific events. Technological change might affect a firm like Kodak, introduction of digital cameras. Weather events for farmers or the farming sector. Commodity prices for the mining sector. So these are all examples of firm-specific or industry-specific events that an investor should be able to get around by diversifying their portfolio, by holding a large diversified portfolio of assets. As long as they're not perfectly correlated, the ups and downs offset each other, you end up with the best level of expected return for a given level of risk. Non-diversifiable risk, however, Richard touched on, equity beta. Systematic risk, and so that stems from macroeconomic factors impacting on firms in aggregate. Whether it be, it's hard to tell whether it be interest rates or a global financial crisis or whatever. It's just the market. When a firm goes down in a way that's correlated to the market, your diversification is going to fail you, and so you tend to want compensation for that. You can't diversify out of that, so that's a risk that you want some return for. And as mentioned, it's measured by equity beta. Okay, for some of you, this might not be particularly interesting, but just a quick rundown of things that affect equity beta when you're implementing in practice. So it's just a basic regression. You get your prices and calculate returns in a particular stock or industry sector, preferably. And you have your market returns, which is usually replicated by a broad portfolio like the ASX 200 or the All Ordinaries. And you just regress one on the other. And beta represents the standardised covariance. In a way, it's standardised by the market risk. So the way that it's correlated with the market in just simple terms. It's preferable, there's quite a few other fiddly things that you can do to make sure you come up with a more precise beta. Some minor cleaning issues, making sure that there's dividend drop-offs when dividends are paid out, the dividends drop off. Making sure that you don't double count that information if you don't have those dividend drop-offs in there and you include dividends at the same time. But these are all fairly minor things. So what I've tried to do is just list some of the things that you should really look out for. As I mentioned, it's preferable, instead of using one firm or looking at each individual firm and estimating their equity beta, it's better to create a portfolio of those firms and make a capital weighted, so they're market capitalisation weighted. That's the weights you attribute to each of their prices, lump them all together to make a portfolio and regress the returns of that portfolio. That's much better. But you don't always have the luxury of doing that. When you select your benchmark firms,
it's really easy in electricity, for instance, to pick a firm that looks like it's in the electricity sector, but it ends up being a retail firm. And the problem with that is they're very different in their operations. They're not capital intensive. They tend to have desks, computers, information systems, whereas a electricity network is a totally different kettle of fish. It has huge network infrastructure, which is very expensive and long-lived. So you really got to make sure that you're separating out your firms by operation, making sure it's the correct one. Outliers, as usual, in regression, that's often a big one to look out for. It's overall, it's not too big an issue, but you might get a firm that produces a very high beta that stands out from the rest, and then you go and actually look at the data. You make a scatter plot, and you suddenly see that the slope that you're estimating, the slope is the equity beta, is influenced unduly by one particular outlier. And so, yeah, the question is, what do you do then? Do you just chuck out that data? But then in our industry, that's seen as manipulating the data, so you can't necessarily do that. So then you have to look at other things, for instance, applying robust regression techniques, LAD or MM estimation, which puts less weight on those outliers, and not just relying on that necessarily, but just comparing it to the OLS estimates, your basic ordinary least squares estimates, and the LAD, just to see the effect that it has, and then you just discuss it and do some analysis based on that.
And also, in practice, so in practice, have you got a scenario where the mean and the median are radically different, and then what happens?
It often is the case for a single firm. You'll get one firm that had a specific event that happened, which makes it, puts an outlier in that data that you're using, and then it'll have a different beta to the rest of the firms, a significantly different beta. Typically, we just use 4 different techniques. We use OLS, TLSEN, which is a non-parametric regression technique, MM, and LAD, and then we just take the average of those 4. So it's not saying, we're not making a call which one is the best to use. They're just 4 acceptable regression techniques, and we just average them out. And then we go with that. It's quite hard if you start trying to justify which one to use over another, because it looks like you're being biased, which is the main issue. So we tend to prefer averages quite often in that sense. And also importantly, equity beta reflects the firm gearing. So if the firm has absolutely no debt at all, it'll just have an asset beta, which is the covariance of its, it stems from its revenue flows, its operating expenditure. If it had no gearing, it would look at its risk relative to the market just on its operating income, but typically firms are levered, and there'll be some level of gearing that is implicit in each, or that each firm has, and that might not be the benchmark efficient level of gearing, or it might not be the level of gearing that you're interested in. So there's different ways of delevering, which is turning equity beta into asset beta, and then relevering by applying your assumed debt ratio and levering it back up. We use the most basic one, the Begley-Myers technique, which is just multiplying equity beta by 1 minus gearing, and then dividing it by 1 minus your benchmark gearing that you want, and that gets you back up to the equity beta, or perhaps down to the equity beta that you are wanting to look at. So there are 3 major issues that will affect your beta estimations. Pretty basic topic. Our chief economist always gives me rubbish that equity beta is just, basic regression, so what? But yeah, there's some of the minor details that are not so minor in its estimation. Anyhow, to try and make it a bit more interesting, why does systematic risk matter? Well, as I'm sure you can appreciate, there's a strong incentive for a regulated entity, they're rational economic agents, to propose as higher equity beta as you can. It gives them a higher rate of return. And so they have what we, it's a little bit cheeky in a way, I guess, but what you refer to as a shopping list of risks. It's things like they'll tell us their end users are riskier than the benchmark firm, their geographic location makes them riskier, risk of terrorist attacks on their pipelines, risks of asset stranding, which touches on what I'm about to discuss next. Most of the examples of risks identified are often diversifiable. we've got an example more recently of the Goldfields gas transmission line. This is public information, by the way, in our last decision. They argue that their composition of end users are very different to typical end users because it's mainly mining companies, virtually all mining companies, nickel, gold, iron ore, and about 4% distribution or something like that, very small. And so they constantly argued for a higher equity beta, a higher mining beta, based on the miners. Their end users have a high beta, mining, compared to the economy market, and so they argued that they should propose that they should have a higher beta. But when we went and looked at the actual volumes and put them into the benchmark model and looked at their earnings, they were pretty unresponsive across the GFC period. Didn't really move much at all. Whether that's because gold is negatively correlated with the market and they serve gold, or they have long contracts, don't know. All we did is look at the data. We can't speculate as to why that is. Not only that, so we're looking for covariance with the rest of the market there. It didn't seem to be very, in fact it was negatively, the earnings are negatively correlated with the market itself. And the other miners were very strongly positively correlated with the market, their earnings. And also the other factor is the degree of operating leverage, so how much fixed costs they have in their operations compared to variable costs. If you have higher fixed costs, it increases your risk or increases your beta because you have to cover your fixed costs, so you have a risk of a loss. But once you're free and clear of those fixed costs, it's just all profit from there. You also have your degree of financial leverage in the gearing as well, and both those act to amplify the covariance in your cash flows. We compared those to other benchmarks, other firms in the economy. They were no higher either. So there was not really much in the way of correlation in their operational earnings with mining companies or the market. And in terms of amplifying any correlation there wasn't really much to say that it's amplified any more so than the rest of the firms, the rest of the regulated firms who are in that industry. A more recent example, which might make it, where I've tried to stretch it to the areas that you guys are interested in, is what they refer to as the death spiral for electricity networks. And there's all these colourful names and reports that have issued out there. I think the Grattan Institute called it a shock to the system or something like that. So I'll just set up the background for this death spiral. A lot of you probably read about it anyway, but per unit charges are typically set at long run marginal cost, sorry. So we use we have the total revenue requirement, and then the unit charge is based on the long run marginal cost, and we multiply it by the 5-year forecast of the units times the long run marginal cost, and then subtract that away from that total revenue requirement, and what's left gets divided across the connections and recovered in a fixed charge. In regulation, often the Turvey method is used for estimating long run marginal cost, which takes the present value of the marginal cost over the present value of marginal demand. So you'll have a model which, when you enter in different demand forecasts, it alters the mix of CapEx and OpEx going forward, and there's annualised costs associated with that. You present value them back, and then you present value the margin back as well, the marginal change in demand. So if there's an extra 3 units permanent change, you present value that up, divide one by the other. It's very uncertain. It's very uncertain because you've got demand forecasts in there, you've got costs in there. There's arguments as to what margin you should use, change it by. It's sensitive to what margin you use, whether you use, say, a change of 3 gigalitres compared to 15 gigalitres, you'll get different results. So it's very uncertain. More importantly, if it ends up on the high side, long run marginal cost, and your units consume falls for some reason, which is what I'm about to go into with the death spiral, then more has to be recovered through that fixed cost. And the issue with these networks, electricity, water, and gas, mainly electricity is the issue here, you have large sunk capital at risk. It's been invested in. We've been taking advantage of the pipeline that runs in front of our front door, or the power lines that run through our front door. Might have increased our property value compared to having nothing there at all. But we've taken advantage of it. It's from a stakeholder's perspective, electricity networks, that cost needs to be recovered. So it's the specific this problem, death spiral problem, is claimed in the electricity industry, and it's the stranding of large chunk assets. Some interesting differences between water supply and electricity is in water supply you cannot avoid fixed charges if you're off the grid. So historical reasons and for health reasons, and the assumption that you're going to be a free rider if you don't pay for it. You can't avoid the fixed charge if you go off the grid with electricity. It's legislated. But electricity you can go off the grid. So you can pull your meter out, use candles or solar panels or whatever, and you can go off the grid. Well, this is the argument that's put forward. You could say that's a technological change, and it's renewables. Affordable home photovoltaic systems, they've come down in cost over the years, fairly easy to install, and perhaps that the future looks that way for batteries as well. And that results in reduced units consumed. So reduced units consumed because you're using solar instead. If you've got a higher, it's more of a problem if you've got a higher long-run marginal cost, because that means you're going to have to charge your next higher fixed charge to recover your costs at the next repricing, next arrangement. And so a higher connection charge to recover those costs introduces a risk of reduced connections. So instead of just using less electricity because you've got your solar, and if there's no requirement for you to stay connected or pay the connection fees, you might just go, well, to hell with it, I'll just go off the grid altogether. And then the problem, of course, spirals. So there's fewer consumers to spread those costs across, and you get this problem, it's the reverse of what Richard indicated before. Instead of having the decreasing long-run average cost, you don't get that advantage anymore. So bringing this back to equity beta, higher risk warrants higher return on equity. That's what they propose, or was often proposed. Investors might not invest otherwise if this is going to be the situation. That's the arguments that are put forward. Well, myself, I'd argue that's a technological change. That's a diversifiable risk. It's not compensated by equity beta. And so what's the solution then? Well, for investors, as we mentioned, according to modern portfolio theory, diversify holdings, invest in solar or other low correlation assets. For employees and end users, well, I'm not proposing any solution here. This is more things that have just been thrown around. It's, well, give a higher WACC to compensate for risk. Well, as I've argued before, that's diversifiable risk, and it's not consistent with modern portfolio theory. Creates an incentive for every time there isn't some sort of problem for them to propose some sort of compensation for that risk, and it ends up being a riskless asset, so why give them any premium? Stop regulating. Well, then you end up with the problem of a natural monopoly. You'll have fewer units produced at where marginal revenue equals marginal cost. And the problem is that consumers that are less well positioned to cope with the increased cost, those who can't afford solar, they'll end up having to pay more. So there's a problem there, but that's more of a normative economics question. You could also argue it might be a good thing. It could accelerate technological progress to produce cheap finance for solar systems and make battery storage cheaper. So there's just trying to provoke some thoughts here, that's all. Maybe a legislative requirement to pay the fixed charge, the same as with water. It's probably going to be pretty unpopular with those who invested in solar. But then you could say the connection improves your land value, just the fact that you have the option there to connect. Could say that there's a cross-subsidy between PV users and non-PV users, so the PV users who stay connected, the PV users who have to pay are subsidising the non-PV users from that perspective for their connection. They can go off the grid. Yeah, there's no right. I'm not saying these are right or wrong answers. Maybe accelerate depreciation, try and get those large fixed costs back sooner in these capital assets. But then you get the same problem. Then the costs, you're going to increase your depreciation, the return of capital, which results in higher costs, and the problem just becomes worse. Yeah, it's just for you to think about. This is the main reason I'm presenting this, and it just touches on renewable energy and some of the distinctions between water and electricity. Yeah, I mean, you could even argue that industry with large loads is probably going to have a harder time getting off the grid, and that means that there'd be a higher industry concentration in the portfolio that the electricity networks serve, and they tend to have a higher equity beta. So we might see that their equity betas increase and they get compensated anyway over time. But yeah, this is all just speculation to stimulate thought. And yeah, that's the end of my part of the presentation. Questions?
Your last point sort of raised a question that I hadn't actually thought about before, and it's probably can apply, of course, to electricity, but perhaps also to water. If you know, maybe in Eastern Australia, a lot of water tanks start being used and so on. So how does this like a public utility, which is right now it's a networked utility, it's providing through some kind of a grid a service to all. What happens in a slow transition from a networked to a non-networked system? So the hypothesis there, theoretical obviously, but going, you know, people going to autonomous, say, photovoltaics. So is that a real problem? I mean, what is the principle for managing? What are the implications? And one can think of comparing, like doing comparative statics, but the problem is in the transition, if that was to happen. And how do you think about this? How do you think about the transitional problem from a public utility that is networked to one that is either not networked or much less networked?
Well, that's the thing. That's why I raise these questions. I mean, do you let it fail? Do you? It might be such a slow transition that you'll have time to recover the costs. There's so many dynamics going on. It depends on what period of time it goes across. If it's they portray it as a shock to the system. They use all these colourful terms and the death spiral and that sort of thing. But there's just so much uncertainty as to the transition of how it's going to happen. If it's very slow, it may not be a problem at all. If it is a shock, like they say, well, okay, then maybe we do have an issue. But yeah, that just means, I guess it's just a more volatile transition then, because I guess theoretically then you'd see them, they'd stop servicing the networks, just run with what they've got. Users will start more rapidly switching to autonomous systems, and then eventually, in the very long run, things will even out, everyone's autonomous, but it's going to be a very rough ride in the meantime.
I would add to that, I think if it was really so rapid that, you know, photovoltaics became really competitive with the network, then we don't need to regulate anymore. I mean, effectively, there's effective competition for the network, so just, you know, that's us out of a job. Great, you know, fantastic. I'm really pleased about that. But you know, in that longer transition, then I think that's the really difficult question that regulators and policymakers are actually grappling with. And you know, this whole issue of the fixed charge, and you know, whether people are, you know, basically taking a subsidy from the grid at the expense of those people who don't have photovoltaics. You know, there's a lot of issues around that fixed charge. The only other thing I would say, which is really interesting about this whole, I mean, and I think you can see it quite starkly with renewables, the recent asset sales of distribution networks in New South Wales, where you'd think, oh, you know, these assets are declining in value rapidly because, you know, everybody's putting a Tesla Powerwall up and, you know, combining that with their photovoltaic system, and they're basically out of there. What we're finding is that some of those retail assets are continuing to sell for 1.5 times the regulated asset base, which means those investors know something we don't know, or we're doing our job really badly. You know, it's a real question for regulators as to why that's the case.
Even if you were autonomous, it's a big call to suddenly just not wanting your connection or having the option there to throw away the option altogether. That's a big step to make. Maybe in the long run that's fine when it's very reliable, cheap and affordable, but yeah, in the short term you're probably better off keeping the connection, the option of having the connection.
And Going back to the high level, so and switching across to water, so we know where this is coming from. So John Freeman has this paper from a while ago saying, if we look at the water infrastructure now, there's no reason to charge a two-part tariff. We charge a two-part tariff because this is the nature of our costs, but the dynamics in the water industry have changed such, and the way that we've added infrastructure is that we're now at a point where, demand intersects rising marginal cost curve, and so we've gone, because of the way we've invested in the infrastructure, we should go towards regulating the price at marginal cost and turning the two-part tariff around and saying, actually, it should be a resource rent tax on utilities. So just at that higher level with the water market, I was wondering if you had any thoughts or views on this characterisation of water markets in Australia.
Well, look, it's not an area that, in terms of policy reform, that given a lot of thought to. I have to confess, often we tend to be tasked with implementation of things that policymakers set for us, and particularly with water regulation, for example. It's really out of our hands to a large degree, and so we do what the Treasurer tells us to do. But I think it's a really interesting question, and I acknowledge the whole issue of desal and the rising average total cost. I think that is a fascinating topic, but really there's nothing I can add for you, James, there, I'm afraid.
Okay, last question from Ross.
Changing tack, is it possible to argue that if you look at Brookfield, and for those of you who know, Brookfield is the monopoly provider of below rail services in agricultural regions in Western Australia, and they have closed what are known as Tier 3 rail lines. Could you argue that maybe they have foreseen the fact that they've got a road mode of transport that is publicly subsidised and therefore competitive against their use of a provision of a service, and in order to avoid the debt spiral that they've closed the lines?
Well, look, I think that's probably a reasonable thing to say and to observe. The question is whether they actually allowed that situation to develop. By allowing the lines to run down, and so they just saw that situation coming and mined the profits while they could, and then we've got this asset that's basically broken. I think that's a really important question against that, and whether the trucking side of the equation has been paying its true costs as well in comparison. So yeah, look, I think that's it's a very interesting topic as to how that situation came about, and I don't think it's as straightforward as just saying, well, those assets were outcompeted by rail, maybe.
Okay, thank you very much. It was interesting. Thank you.